Hello, everyone. Welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos, and today I'm excited to be joined once again by Wium Malan, who will share an updated view on key IT services companies in India, such as Tata Consultancy, Infosys, Wipro, and HCL Technologies. Wium is a global equity analyst with more than 13 years of experience on the buy side, covering companies in emerging and developed markets. He specializes in fundamental and quantitative analysis on companies in the internet, telecommunication, media, technology, IT services, healthcare, pharmaceutical, and other industrial sectors. Wium, welcome once again. It's very good to have you with us. The floor is yours.
Well, thanks, Michael. Thanks for that introduction. Appreciate that. And thank you to everyone who's joining today. As Michael said, we are going to talk once again about the Indian IT services companies and what's been the recent developments there and what the outlook is and sort of what my picks and pans are over the medium to longer term. So just as a little bit of background to set up the analysis. So as Michael quickly alluded to, we're going to talk about Tata Consultancy Services, Infosys, Hcl Technologies, and Wipro. And just as background, when we last did the webinar in August, I gave a detailed industry overview. We looked at the competitive advantages of the companies, their relative geographic and vertical exposures, and how that differs between the companies. We looked at the financial fundamentals, the corporate governance situations, and also the differences in ownership and management dynamics. And then finally, we looked at some of the shareholder return policies and practices and the issues around H-1B visas at that time. So for more detail on that, I would urge you to look at the previous webinar and some of the other insights that I have put out. My conclusions at that time, around 6 months ago, was that I was getting overall less bullish on the sector following really strong share price performance since their lows in March 2020. But I was still bullish longer term given the high quality of the companies, their competitive advantages, big potential for cash returns, and especially in a low interest rate environment. So at that time, my picks in order of preference was, first of all, for HCL Technologies, given the evolution to more software as a service offerings, recovering returns following a lot of acquisitions done earlier. There was valuation support, and we were in the beginning of an earnings upgrade cycle. That didn't play out really well, which I'll show on the next slide. And the company has disappointed somewhat operationally over the last couple of quarters. My following pick was for Wipro, given their large cash balance, their relatively low ex-cash next 12 months PE ratio, and the big discount that was trading versus the other companies. And then that did play out really well as we saw a lot of cash returns and buybacks coming through from the company, and they've executed well on a turnaround strategy, which I'll touch on a bit later as well. Then lastly, with the companies I didn't really like at the time was Infosys and Tata Consultancy, and those have underperformed over the last 6 months. Infosys really had excellent execution at the time, and there was corporate governance overhang removed, but they had already outperformed. And Tata Consultancy Services, although they remain the best in class, the valuation premium was just too much, and they were underperforming on a relative basis. So then this week, I published an update on this industry, which I urge you to have a look at, which shows more detail about what we're discussing today. It's called Indian IT Services is a multi-year hypergrowth, because that they've had is whether we are still in the early stage of a multi-year hypergrowth scenario, and also whether that might already be priced in. So just quickly looking at what's happened over the last 6 months in terms of share price performance, the clear outperformer has been Wipro, especially, which is the green line there, especially since the results were released earlier in the month or last month. And the other stocks really performing in line with the local equity indices, so nothing really to write home about. We've seen some underperformance from Tata Consultancy and Infosys, and then especially HCL Technologies following the most recent reporting period. Which brings us to where the valuations are today. So if you look at next 12-month PE ratios, it's still Tata Consultancy Services, the best-in-class company commanding the highest PE ratio. But the real standout here is Wipro, that's re-rated significantly this year and is now trading at the premium to even the likes of Infosys. whilst HCL Technology, especially with the recent sell-off and earnings downgrades that's come through, has derated and is now trading at sort of an all-time big discount to the likes of Wipro, which it is often compared against. So what happened in the results? So just looking at the last sort of year, and these are the group constant currency revenue growth numbers. So that's top line and constant currency. First of all, we can see that there's been a meaningful growth acceleration over the last couple of quarters from all these companies as they've come out of the COVID-19 pandemic hit first part of last year. So on relatively easy comps, the companies have accelerated growth. So if we remember, COVID-19 hit sort of in January last year, with the first quarter affected somewhat. I do expect really strong growth numbers for the coming quarter to end of June, given that the trough impact was really around June 2020 for these companies last year. Looking at the relative performance of the companies, it was again Infosys who delivered the best performance. They've got a really strong performance and a turnaround performance in especially their financial services businesses based in the North American region. Tata Consultancy Svcs continue to accelerate their growth. Hcl Technologies disappointed, especially in Europe, given a relatively higher base that they have due to acquisitions that were fully sort of worked in a year ago. And then Wipro, although the number is the lowest of the ones here, that was really a standout performance versus market expectations, especially because they managed to add a lot of large new signings. And with the change in CEO about a year ago, there's been restructuring on the management team side, and it seems like they've done that really well. And their outlook for growth is definitely improving. So there's a nice turnaround story, which has been reflected in the share price movements of late. Looking at the operating margins, we can see that towards the end of the previous financial year, there was big margin accretion for all these companies. Now, a lot of that was due to cost deferrals during the pandemic hit last year. So a lot of the discretionary costs like travel and visa expenses, and especially wage hikes, were deferred to later periods. And in the most recent quarter, we saw the early signs of costs returning to some form of normalcy. So for all the companies, apart from Tata Consultancy Services, we did see some margin pressure. A lot of them instituted wage hikes towards the end of the last financial year. And I think they all will see further margin pressure going forward. And the management teams have alluded to this, given that they're returning to normal wage hikes somewhere between April and July this year. It's also worthwhile noting that these companies have been operating at really high utilization levels due to low hiring activity last year. Now, hiring activity has picked up. The attrition levels are still relatively low for most of them, but I do think we'll see an impact to margins from that normalizing going into the next couple of quarters. So we should see really strong numbers in revenue growth next quarter. I do expect some margin pressure, which could be a headwind if you're not anticipated by the market. Which leads me to where sell-side expectations currently are. So you can see over the last 6 months, the earnings upgrade cycle has continued for all the companies, and it's only really HCL Technologies which disappointed in the last reporting period, especially given a rather muted outlook for growth. And we've seen earnings downgrades coming through there. But for all the other companies, the earnings upgrades have continued. Which brings me to sort of the analysis of what I think the key controversy is currently. So all the management teams alluded to double-digit revenue growth for the coming year. Now, that is a very big acceleration from what they've done over the last sort of 5+ years, but it is very achievable off the relatively low base set last year. So what I've tried to do is gauge where market expectations are before we look at sort of what valuations mean. So on this chart, I've looked first of all on the blue chart what the past 3 years compound annual growth in revenue in constant currency has been. And we can see the acceleration that's happened now looking at sell-side expectations for the next financial year, which are the red bars there. Just one caveat there, if you look at HCL Technologies, past 3 years compound annual growth, that is distorted by acquisitions. I estimate that organic growth will probably be around 6% less than the number shown there. So still very nice acceleration. Also then comparing where the sell side are versus recent management guidance, you can see that the sell side is already well ahead of that. Just also another caveat on the guidance numbers. If you look at TCS and HCLT, the green bars, they show 10%. That's just to show that they said double-digit revenue growth. For HCL Technology, management even went further to say that that really serves as a floor for their growth. And they do, admittedly, they are conservative on that. But again, the message is that the sell side expectations are ahead of where management is guiding. But I think then what's more interesting is if you look 3 years out from now and you look at longer term compound annual growth expectations, they're all well above the double-digit level. So just to frame this in context, the industry over the last 5+ years has been growing globally sort of low single-digit levels, where these guys have been growing high single-digit levels, taking market share, given their competitive advantages. So going from high single digits to really meaningful double-digit growth here is a very meaningful acceleration. If you look at 3-year compound numbers, that does imply really strong growth forecast already for the coming sort of 3 years. Now, to put this into context, I tried to figure out, what happened during the previous hypergrowth periods that we've witnessed. And I had to go back to sort of financial year 2011 to 2015 for the various companies to see how they performed then and to look at the relative valuations and see what that tells us. So what's interesting here is you can see during that previous hyper growth period, TCS and Infosys delivered well above 20% compound annual growth, really outperforming the rest of their peers and really gaining a lot of market share. So that was a very strong performance for them, and that sort of set up the relative PE valuations and the biases within the valuations in the market for a very long time. Very interesting then to note how Hcl Technologies and Wipro underperformed relatively versus that period, but still gained global market share. During that period, it needs to be noted that a large part of both Wipro and Hcl Technologies revenue is driven by infrastructure management services. So it's a lot more hardware and data center type businesses, which did grow a little bit slower than the bread and butter IT services that the other companies delivered more of. Another interesting point to note here is I looked at what the earnings per share compound annual growths were as well. And apart from Hcl Technology, there wasn't a lot of leverage in these companies. Now, granted, there are some FX moves in here, but if you look at the operating margins during that period as well, there wasn't a lot of operating leverage achieved by the companies, which is kind of counterintuitive because you'd think with companies like these and the hundreds of thousands of employees that they have, which are sort of semi-fixed costs, it shows that they've been really good at managing those utilization levels and turning on and off the taps when it comes to hiring and managing attrition levels. Also, these companies built up a lot of cash balances during the period, which sort of negated any possibility for financial leverage. And Hcl Technologies, we did see operating leverage, and again, that was because they did a lot more sort of hardware type services or infrastructure management services where they benefited. I think the takeaway of this, comparing it to the current period that we're in, is that it really helps by just looking at the revenue growth rate expectations going forward and not to expect a lot of operating leverage, because apart from maybe currency moves or anything strange that happens structurally with the business mix, there is not massive room for operating leverage usually, and with the high cash balances that the companies already have, there isn't a lot of room for financial leverage. So then looking at what the P ratios are compared to those growth rates. So first of all, on the left-hand side, you can see the current P ratios, which are definitely significantly higher to what the long-term historical average P ratios for the companies has been. Which we already know, which indicates that the buy side expectations probably significantly higher than the sell side expectations. And it's also interesting just to look at that versus the previous hypergrowth period. And the current valuations are not only higher than the average valuations during that period, they're also higher than what the peak valuations were during that period for all the companies apart from Hcl Technologies. And Hcl Technologies really is just because of the derating we've seen over the last couple of weeks to a month. So I think the two takeaways here is, first of all, when we look at the hypergrowth period, the previous hypergrowth period, there was mean reversion in the multiples from peak levels. And also, if you look at the current valuations, they are higher than the peak multiples in the previous hypergrowth period. So, all else being equal, I would expect a de-rating in these shares going forward. Then lastly, what I tried to do was assess where the buy side expectation or the market's expectations currently are on a 3-year growth ratio. And to do this, I assumed that we get a PE ratio, mean reversion back to historical average levels over the next 3 years and see what the implied EPS growth is. Now you can see from the bars on the left-hand side there that the implied growth rates for all the companies outside of Hcl Technologies is around 20%, which is meaningful acceleration in growth. That is a big number, which also brings questions around whether there really is any operational financial leverage to achieve that. That is significantly ahead of where the sell side forecasts are, but it's also significantly ahead of what they delivered in the previous hypergrowth period. Apart from maybe TCS and Hcl Technologies. Now, in the previous growth period, there are FX numbers in there, but it does show that maybe TCS and Hcl Technologies does have slight room to surprise on the upside, but for the other ones, the expectations really are very high already. Just a last point to quickly touch upon, and this is something that hasn't really been discussed in the market or by the management team yet. It's just because of the late significant resurgence of COVID in India and the terrible situation that they are in at the moment. The impact of this on the Indian IT services companies is obviously very, very difficult to estimate. They need to remember that 90% of their clients are outside of India to a large extent, and so it should be business as usual there. However, with the increased onshoring, most of the employees are still in India. We also need to note that these guys were incredibly good at getting more than 95% of all their employees into some form of remote working or work from home situation within weeks after the pandemic hit last year. So my gut feel is that the impact will be rather muted, but it is definitely a negative for the coming quarter that I think we need to take into account, especially given how high the expectations are already for these companies. So then just to sum up, before we see if there are any questions, I remain very cautious on the sector, given where the valuations are. These valuations are based on elevated earnings growth expectations, and it seems like there's already a multi-year hypergrowth scenario priced in. If I had to choose on a relative basis, I do still prefer Hcl Technologies, despite their recent operational underperformance. But given where the valuation is and what's happening with terms of the growth numbers in the company and the margins, I would wait for a better entry point before going long. I think we need to be cautious in terms of near-term headwinds from the COVID-19 resurgence in India. And what we've seen in these companies in the past is that if there is any earnings misses, the market will punish them severely, especially in the local market. And we saw that with Hcl Technologies most recently, but these guys usually have big share price movements if there is any negative surprise. Then if I had to say where I could be most wrong, I think if Wipro continue to deliver and surprise with their turnaround story, there could be further share price momentum behind the company, even at current valuation levels, especially if they manage to execute well on their upcoming Capco acquisition, which they aim to close in the coming quarter, and if they continue to make large deal wins to accelerate the top line growth. But as I said, at the current valuation levels, the margin of safety is really, really minimal if they do manage to or if they do end up disappointing on that front. So I think, Michael, with that, I'll leave it and we can see if there are any questions.
Thank you very much for that, Wium. We have seen that tech investors, especially globally, have been hesitant with concerns of rising inflation. Is there an impact to these stocks in your view in this regard?
Yeah, that's a good question, Michael. So I think first of all, operationally, there's not a big impact. A large part of what these companies do is not really big inflationary products. So I don't think it'll operationally have a big impact. But These companies have performed so well last year, and I think a large part of that is because they are more defensive. They do have big cash returns in terms of buybacks and dividends that they pay, and it's really high quality companies. So I think if we do see a continued rotation into the more cyclical stocks as inflation goes up and expectations for rate increases go up in the US, these stocks will continue on a relative basis to be under pressure going forward.
Understood. In August, when last we looked at these companies together, we had briefly mentioned concerns over in the U.S. with what was then the administrative environment with H-1B visas. Now that the U.S. is under new management, so to speak, is it a different situation?
Yeah, it's definitely turned for the positive. I mean, there's been more concrete evidence that there's not going to be as much interference by the US administration into the H-1B visa issue. I do think we need to just as background note that there's always a limitation on the amount of visas that are issued every year, and there is a big competition between these companies to get those visas. But what's been more interesting in terms of that is not necessarily the scarcity around H-1B visas and the uncertainty about guys who are already in the US, whether their visas will be valid or renewed. It's more with the COVID-19 pandemic, we've seen all these guys offshore significantly more. So what that means is that there's a lot more of their workforce based outside of the operations of their clients. So it's more in India and even other geographies that they are hiring, and that's been really positive for margins. And if you see the lingering effects of COVID-19, I mean, you got the massive resurgence in India of the pandemic, the struggles they're having around vaccinations. And I'm seeing that across all emerging markets. Even here in South Africa, we are really, really struggling to get the vaccine rollouts going, which means there's a big difference that's coming between what we're seeing happening in countries like the US and the UK, and maybe even parts of Europe versus these developing nations. And I think to have travel return to normalcy and for these guys to move a lot of employees from India back to places like the US or the UK is going to be very tough. That's going to be the delays. So it's going to be more difficult to move around their workforce. But on the flip side, increased offshoring, if they do manage to keep their relationships really strong with clients and they can do that, it really benefits them on, what their key competitive advantage really still is labor arbitrage to a large extent. So, to answer your question, I think the H-1B visa issue has become a bit of a non-issue at the moment. I think it's more about how the pandemic plays out in developed versus developing nations going forward.
Right. If I might follow that up really quickly, you mentioned, of course, how the COVID resurgence can have an impact, especially with how it's been handled in countries like the US and the UK. What about countries on the Asian side, where we are seeing little hits of resurgence here and there across developing and developed markets here? Do you think there's a potential impact there?
Yeah, so the big dynamic that you need to take into account with these companies is that for most of them, roughly 50% of their revenue comes from the North American region, so the US. And let's say somewhere between 15 and 30% comes from Europe, and the rest is sort of in bits and pieces. Some of them are trying to grow in the likes of Japan. There's not a lot of demand for their services in China because China does a lot of it themselves. So the real demand side is in the US and Europe, and then a large part of the supply is still in India, some in country in the US and Europe, and then some smaller Asian countries that they have employees as well. So I don't think the ups and downs we're seeing in places like Korea and Japan and that will have a massive impact. It will definitely impact the companies at the margin. But I think the bigger issues would be what happens in India on the supply side and how well the companies manage that in terms of their workforce, and then in the US in terms of the demand side.
Understood. Thank you. An attendee asks, do you have any view on Cognizant Technologies, which is a fairly large player in the Indian IT services space, although it's listed in the US? I guess it's not part of the group of companies that you have looked at today, but do you have any view on how perhaps it compares?
Yeah, so I mean, I don't have a concrete view. If we take it online, I can talk a little bit about that. I haven't done a detailed analysis of them. I've really focused on the emerging market names, but I know it is in terms of valuation levels, a lot of the same dynamics kind of apply to them as well. But no, I don't have anything further concrete to add there.
Thank you very much for that. If there are no other questions, we can wrap it up. Thank you very much, Vium, for sharing your views today. As Vium mentioned, there is considerable work on the Smartkarma platform in this regard. So do seek out Vium's insights on the topic. And also, you can revisit the previous webinar that we did in August 2020. We will have a link to that as well. If there are any other questions, or if you want to follow up on questions with Vium, you can reach out to your Smartkarma account manager. They will be very happy to help you and connect you. And if you have any other questions, you can email us at research@smartkarma.com. Vium, thank you very much once again.
Thanks, Michael.